Welcome back to Investing Talk podcast.
Today we're looking at Dragonfly Energy, ticker DFLI. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We really have to start with the news from October 2025 because it fundamentally shifted the investment landscape for DFLI. For most of the year, this stock, well, it's been under this cloud of existential risk, and that cloud just lifted.
Okay, let's unpack this. The first major point, then, is that they solved what had become a massive headache, that constant threat of delisting due to Nasdaq noncompliance. When a stock is trading way down near the floor, that compliance threat is often the #1 reason institutions just flee.
Exactly. It can create a real death spiral. So the confirmation they received on October 21st that Dragonfly Energy regained full compliance with the minimum bid price and market value requirements.
Right.
Well, that's incredibly important for de-risking the stock.
Right.
Now, they aren't totally out of the woods. They remain on mandatory monitoring for 1 year, but the immediate severe threat, it's gone. And that allows capital to potentially flow back in.
De-risking is crucial, absolutely. But the financial pivot, the really big news, was the capital injection itself, wasn't it? I mean, a compliance win only opens the door. The money is what actually pays the bills.
Precisely. That's the foundational change we're watching right now. They announced a proposed public offering on October 15th, and then just 24 hours later, they priced a massive $55.4 million public offering.
Wow.
Yeah, this is not a small raise for a company of this size. It strengthens liquidity dramatically and basically eliminates those immediate solvency concerns that plagued them earlier in the year.
$55 million. That's real money. So the central question for anyone considering DFLI now must be, how will management actually deploy that fresh cash? Is it going toward just plugging holes, or is it fueling, actual growth?
That's exactly what we need to watch in the coming quarters. Historically, large capital raises like this, especially following compliance issues, they're typically earmarked for a few key things. Bolstering cash reserves, obviously. Accelerating R&D for next-generation products is another one. And potentially increasing inventory to meet future demand. They're essentially buying stability in time.
Okay, and what was the management communicating in the months leading up to this huge raise? Were they signaling this turnaround was coming, or did it catch people by surprise?
Oh, they were absolutely laying the groundwork. If you look back at August and September, management was actively emphasizing their sustainability positioning, talking up their next-generation internal battery management developments, and repeatedly reassuring investors, following some pretty severe share price volatility. They were definitely signaling resilience and working hard to build a favorable narrative ahead of the capital raise.
So they didn't just stumble into this money, they sort of staged the comeback.
You could say that, yes. They positioned themselves for it. So if we connect this to the bigger picture, the capital's in the bank, the compliance issue is settled for now. What this means is we move from monitoring existential threats to, pure execution monitoring. All eyes are now on the clock, specifically the next 3 months. We need a detailed scorecard, basically.
Right, and here's where it gets really interesting for investors, I think. You mentioned hard dates. For the average person tracking DFLI, which of these is the absolute must-watch? What should they circle on the calendar?
Top of the list, no question, has to be the Q3 2025 earnings release on November 14th. This is the first real chance we get to see not only their operational performance before the cash injection, but also, crucially, management commentary on how that $55.4 million is going to be used in Q4 and beyond. This report is the immediate stress test for the turnaround story.
Okay, Q3 earnings November 14th. Got it. Beyond the strict financials, what about market dynamics? Anything else to watch?
Correct. We also have to track capital market movements. Specifically, keep an eye out for the ETF rebalancing review on December 18th. Given DFLI's recent volatility and this sharp reversal, inclusion or exclusion from major specialized ETFs could significantly affect share demand and trading flows.
Ah, right. Especially if large institutional funds are mandated to buy or sell based on index inclusion. That makes sense.
Precisely. It can create forced buying or selling pressure.
And since they cater heavily to discretionary markets like the RV and marine sectors, seasonal demand must be absolutely vital for them.
Absolutely. So the holiday sales operations report, which we expect around December 24th, gives crucial insight into that seasonal demand for their core lithium power offerings. If consumers are still spending on big-ticket items like RV upgrades or marine equipment this holiday season, that indicates health in DFLI's key markets.
Okay, good indicator.
Then, just after the new year, watch the institutional buy reporting window around January 12, 2026. This date is important because it will show if major money managers, the big funds, finally felt comfortable returning to the stock now that the immediate compliance risk is off the table.
Okay, that sets the timeline pretty clearly. Now let's talk about what they actually sell, because like you said, a great balance sheet means nothing without a durable product, right? DFLI isn't just a commodity battery maker. What's their actual competitive structure? What makes them different?
Well, what's fascinating here is their specificity. They specialize in deep cycle lithium-ion power systems, sure, but they focus very heavily on specific, often high-margin niche markets. Think recreational vehicles, RVs, marine applications, solar or off-grid setups, and mobile energy storage.
Yeah.
These aren't just casual consumers, these are often users who rely on battery performance in remote or demanding environments.
Right. And I imagine anyone who's owned an RV and had a cheap lead-acid battery die on them miles from anywhere understands the appeal of premium lithium tech. Is that brand loyalty a real asset for them?
It certainly seems to be. They've built strong brand recognition in those verticals, especially in the U.S. RV market. But the real moat isn't just the target market, it's the technology stack they provide. They are vertically integrated.
Okay, explain that vertical integration. So they aren't just buying battery cells from overseas and slapping their label on them.
No, far from it. They offer the entire solution. They provide the battery itself, yes, but also the sophisticated internal management software, the alternator regulators, the chargers, and the monitoring systems. By providing a comprehensive, integrated system, they control the user experience from end to end.
I see.
And that integration creates a much more defensible moat against generic, low-cost competitors who might just sell cells or simple battery packs. If the whole system is branded and works together seamlessly, switching costs go up significantly for the customer.
Okay, that makes sense. A strong, niche, integrated system sounds good. But now for the, let's say, sobering side. While the moat seems strong and the technical momentum is clearly roaring right now, the financial reality needs a serious check, doesn't it? You can't just live on hype and fresh cash forever.
No, you absolutely cannot. We have to maintain balance here. Despite that massive recent capital raise, the core financials show significant strain, which frankly cannot be ignored. We have to look at the red flags that any long-term investor must confront.
All right, give us the hard numbers. How much is the top line shrinking? That seemed like a key concern.
It is. The trailing 12 months revenue, or TTM revenue, looking at the last full year, is $54.54 million. Now, that might sound okay in isolation until you realize that's a sharp 21.35% decrease year over year. The top line is significantly contracting, which suggests either market headwinds or perhaps losing market share somewhere. It's a big drop.
21%? Ouch. And the cost side is equally worrying, I gather. What about profitability?
Painfully so, yes. The net loss TTM is widening at a worrying negative $30.45 million. That results in a TTM EPS, or earnings per share, of negative $3.63.
So they're bleeding cash operationally.
They are. And while the recent $55 million raise addresses the immediate liquidity crunch, the long-term financial structure is deeply worrying.
I saw that negative debt-to-equity ratio you highlighted,
Yeah.
minus 254.2%. A ratio that negative is like a siren going off for long-term health, isn't it? What exactly does that mean for someone maybe just learning these metrics?
Yeah, that is probably the most critical fundamental warning sign right now. A negative debt-to-equity ratio means the company has negative shareholder equity. In simple terms, it signals that their accumulated losses over time are greater than their total assets minus their total liabilities. They're essentially running on fumes built up from past losses.
Wow.
So you have structural debt issues combined with continuous operational losses. This puts extreme pressure on management to turn things around fast.
Which means management absolutely must execute flawlessly with that new $55 million. If they don't significantly reverse those losses quickly, they'll inevitably face another funding round, which means further shareholder dilution down the road. That seems like the core risk.
That is the primary financial risk for long-term holders, without a doubt. Effective execution is completely non-negotiable right now. However, just to keep perspective, there is one fundamental sign of resilience we shouldn't just brush aside: the gross margin.
The green flag among all the red ones.
Exactly. The gross margin is surprisingly robust at 25.56%. This suggests they actually have pretty strong cost management relative to their peers. Even with that top-line softness, they seem to be controlling their cost of goods sold quite well. So if, and this is of course a big if, They can turn those revenues around using the new capital. That high margin will pay off immediately in a big way on the bottom line.
Okay, so potential leverage there if revenue picks up. Now, if we connect all this back to the market action, the technical picture seems almost completely detached from that fundamental risk right now, doesn't it? The bullish technical momentum is clearly overshadowing the balance sheet pain, at least for the short term.
Oh, absolutely. It is the ultimate momentum play at the moment. The reversal has been phenomenal, really. The stock is up sharply to $1.20 from yearly lows that were down around $0.15. And remember, it surged over 36% on October 3rd alone, right around that compliance news hitting. That signals massive renewed interest and a definite shift in market psychology.
And what specific technical indicators stand out to you? What's driving that chart?
Well, the alignment is pretty much perfect for momentum traders right now. All the major moving averages, the 50-day, the 100-day, the 200-day, they currently signal a buy. When the short, medium, and long-term averages all point up like that, it suggests the market herd is strongly moving in one direction. Furthermore, indicators that measure trend strength, like the ADX, are very strong at 44.96. Generally, anything above 40 indicates an undeniable, powerful trend is currently in play.
And that strong technical signal must be why we see such a huge range in price targets. You have analysts with a relatively conservative strong buy rating and a 12-month target of $1.50, which is still over 30% upside from here. But then you have that much higher speculative target floating around.
Right. The speculative high estimate goes all the way up to $2.90 in the near term. This massive gap between the, let's say, formal analyst target and the speculative high, that's driven entirely by strong speculative cross-currents in the market. And those are often fueled by, well, rumors.
Okay, let's talk about those rumors. What are the key ones circulating that could potentially push the stock towards that $2.90 ceiling? What are people whispering about?
Well, we're hearing persistent talk about expanded OEM partnerships, specifically securing a large new contract in either the RV or marine sectors. A major original equipment manufacturer deal like that would really solidify their recurring revenue base.
That would be big.
Huge. Then there are always rumors about a major announcement regarding next-gen battery technology, something that would widen that competitive moat even further. Maybe a patent breakthrough,
Right, something proprietary. What about geographical expansion? Are they stuck in the U.S.?
That's another angle, yes. Talk of potential expansion into European or Asian storage markets to diversify revenue away from their currently very U.S.-centric RV focus. And critically, analysts are actively speculating about strategic M&A activity now, post-capital raise. With $55 million sitting in the bank, they could potentially acquire a smaller competitor or maybe a key technology supplier.
Consolidate their position.
Exactly. Consolidate their position in sustainable energy storage. Lots of possibilities swirling around.
Okay. So let's try and synthesize all this. What does it all mean for the person listening to us right now? The Outlook summary we developed points to an 800 and overall bullish rating, which seems remarkably high given those deep financial risks we just discussed.
It does seem high, and it raises the single most important question, I think. Who is this stock actually for right now? Because it's not for everyone.
Yeah, let's break down the investment horizon based on that risk profile. Who should be looking at DFLI?
Okay, so for the short-term view, look, this is highly attractive for aggressive traders. People seeking momentum around that upcoming earnings report and those potential news catalysts we mentioned. The potential upside, if those rumors materialize, could be substantial, up to maybe 135%. And this is crucial, you have to understand the trade-off. Volatility is extremely high. We're talking 41.2% weekly volatility.
40% weekly swings.
Yes. It massively amplifies both risk and potential gains. It is a high-stakes momentum play, pure and simple.
Okay, so that's the trader profile. What about the long-term investor? Is there real structural value here, or is this just a trade?
Well, the potential for structural value creation does exist, but it is highly conditional. It relies entirely on Dragonfly Energy successfully executing on innovation and successfully leveraging that massive macro trend toward electrification. The core technology seems sound, the niche is strong, and the market tailwinds are definitely there. But the financial discipline and the ability to convert that new capital into profitable revenue must follow through. If they manage to fix the fundamentals, then yes, the stock could soar far above the current targets in the long run. But it's a big if.
So summing it up, a stock showing absolutely explosive technical momentum and fresh liquidity, but it's burdened by a shrinking top line and widening losses that signal some pretty serious fundamental strain.
Exactly. And the key takeaway for you, the listener, is this. Monitor that November 14 earnings report very, very closely. Did they immediately use that $55.4 million to start narrowing the losses, or maybe to significantly widen their competitive moat through investment? That report, and the guidance they give, will likely be the deciding factor on whether this dramatic reversal holds or fizzles out.